Before we begin, please be aware that the content in this presentation is for informational and educational purposes only. It should not be considered as financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. I am not a licensed financial advisor. All strategies and case studies discussed are based on historical data and are not indicative of future results. Please conduct your own research and consult with a qualified professional before making any investment decisions. $6.6 trillion. That's not a typo. $6.6 trillion. That is the amount of money that changes hands on average every single day in the global foreign exchange market. To put that number into perspective, it's more than the New York Stock Exchange, the Tokyo Stock Exchange, and the London Stock Exchange combined. It is, by an enormous margin, the largest financial market on the planet. And for years, it felt like a private club, accessible only to massive banks, hedge funds, and guys in $1,000 suits shouting into 5 phones at once. But now, you can access a piece of this colossal market from the same app you used to check on your favorite stocks. Right there on Robinhood. You've probably seen it. You're scrolling through your watch list past the tech giants and the meme stocks, and then you see these strange cryptic symbols. Euro to US dollar to Japanese yen, pound sterling to Australian dollar. It looks like a secret code, a part of the app you're not supposed to touch unless you have a PhD in economics. You've heard the term Forex, but it's always been this vague, intimidating concept. What if I told you that this so-called secret code is actually simpler to understand than the balance sheet of most public companies? And what if I told you that by understanding it, you unlock a perspective on the global economy that most retail investors completely miss? This is your definitive guide, specifically for the US trader, on how to navigate the world of Forex on the Robinhood platform. We are going to demystify every single aspect of it. We're going to take that confusing wall of numbers and turn it into a clear, understandable landscape of opportunity. We're not just going to define the terms, we're going to build a foundational understanding from the ground up, so you can look at the global market with confidence and clarity. The first thing you have to understand, and this is the most critical mental shift you need to make, is that Forex is not like stocks. When you buy a share of Apple, you are buying a tiny piece of ownership in a company. You believe in their products, their leadership, their potential for growth. You're betting on the success of a business. When you trade Forex, you are not buying a company. You are, quite literally, trading money itself. You are exchanging one country's currency for another, based on the belief that one will become stronger relative to the other. It's a direct play on the economic health, political stability, and monetary policy of entire nations. It's a macroeconomic tug-of-war, and every trade is a bet on who's pulling harder. Think about it this way. You've actually already participated in the Forex market, you just didn't do it on an app. If you've ever traveled from the United States to Europe, you went to a currency exchange and sold your US dollars to buy euros. You did that because you needed euros to buy a coffee in Paris. You were hoping for a good exchange rate so your dollars would get you more euros. Now imagine doing that, but instead of needing the currency for a vacation, you're exchanging it because you believe the euro is about to get stronger against the dollar over the next few hours, days, or weeks. That's it. That's the core concept of Forex trading. You're buying one currency while simultaneously selling another, aiming to profit from the change in their relative value. So let's break down that secret code. Euro to US dollar. This is called a currency pair, and it's the heart of every Forex transaction. It's always two currencies. The first one, in this case the euro, is called the base currency. The second one, the US dollar or USD, is the quote currency. The number you see next to it, let's say it's 1.08, is the exchange rate. This simply means that 1 unit of the base currency costs 1.08 units of the quote currency. So 1 euro costs $1.08. When you buy euro to US dollar on Robinhood, you are betting that the euro will get stronger, or that the US dollar will get weaker. You believe that the exchange rate is going to go up, maybe from 1.08 to 1.09. When you sell euro to US dollar, you are betting on the opposite, that the euro will weaken or the US dollar will strengthen, and the exchange rate will go down. It's a zero-sum game between two massive economies, and the price reflects the global consensus on which one is winning at that exact moment. Now, why should you, a savvy stock trader, even care about this? First, diversification. The factors that move currency markets are often different from what moves the stock market. A bad earnings report from a single company can tank its stock, but it will have little effect on the US dollar. Conversely, a statement from the Federal Reserve about interest rates can send currencies swinging wildly while the stock market might take time to react. It's a different world with different rules and different drivers. Second, accessibility. Unlike the New York Stock Exchange, which has its set opening and closing bells, the Forex market is a decentralized, global market that operates 24 hours a day, 5 days a week. It opens on Sunday afternoon in New York as markets come online in Sydney and Tokyo, and it doesn't close until Friday afternoon when the trading day ends in New York. This provides a level of flexibility that the stock market simply can't match. And third, insight. Understanding currency movements gives you a powerful new lens through which to view all of your other investments. Wondering why your favorite tech company with huge international sales is having a tough quarter? It could be because a stronger US dollar is eating into their overseas profits. Understanding the strength or weakness of the dollar isn't just a Forex thing. It's a fundamental piece of the global economic puzzle that affects everything. This guide is specifically designed for how all of this works inside Robinhood. We'll cover the exact pairs they offer, the fee structure, which is different from how you might pay for stock trades, and the unique tools and limitations of the platform for US-based users. Other guides might give you broad, generic information, but we're going to focus on the practical, actionable knowledge you need to operate within this specific ecosystem. Over the course of this series, we're going to build your knowledge brick by brick. We'll move from these core concepts to understanding how to actually read a Forex chart. We'll break down the major economic reports, things like inflation data, employment numbers, and interest rate decisions, and show you how they can cause massive volatility in these pairs. We will explore the different types of trading analysis, from looking at chart patterns to understanding the fundamental economic drivers of a country's currency. We will walk through the mechanics of leverage, a powerful tool in Forex that can amplify both potential gains and potential losses, and discuss how to approach it with a structured risk management plan. We'll look at case studies of historical market movements to see these principles in action. By the end, you won't just see a symbol like US dollar to Japanese yen. You'll see the story of the relationship between the world's largest economy and one of its most important export-driven nations. You'll see the dance of interest rate differentials and the flow of global capital. That confusing code will become a clear sentence, and you'll be equipped to read it. But before we can dive into the charts, the strategies, and the economic calendars, there is one absolutely critical difference between trading a stock like Tesla and trading the US dollar itself. It's a difference measured in incredibly small increments, a concept that forms the very foundation of how profit and loss are calculated in this market. If you don't understand it, it's like trying to play baseball without knowing what a strike is. It's a fundamental piece of the puzzle that could lead to very costly misunderstandings. And it all comes down to a tiny unit of measurement called a pip. So what exactly is this pip? The word itself stands for percentage and point, but honestly, forget the acronym. It's confusing. Think of it like this. A pip is to a currency pair what a single cent is to a dollar. It's the smallest standard unit of change. When you see the price of the euro versus the US dollar, or euro to US dollar, it might look something like 1.0852. If that price moves up to 1.0853, it has moved up by one single pip. It's that fourth digit after the decimal point. That's the battlefield. That's where the microscopic tug-of-war between buyers and sellers happens every single second. Now, you might be looking at your Robinhood app and see a fifth decimal place like 1.08525. That fifth digit is called a pipette, or a fractional pip. It's 1/10 of a pip. For our purposes and for keeping our sanity, we're going to focus on that fourth digit, the full pip. It's the industry standard and the number that truly matters. Most major currency pairs like the euro/US dollar, the British pound/US dollar, they all follow this rule. The fourth decimal place is the pip. The only major exception you need to know about is any pair involving the Japanese yen. Because the yen has a much lower value compared to the dollar, a pip is the second decimal place. So if you see the US dollar versus the Japanese yen, or US dollar to Japanese yen at a price of 157.35, and it moves to 157.36, that's a 1 pip move. Simple as that. Fourth decimal for most, second for the yen. But here is the million-dollar question, the one that trips up almost every new trader. How much is a pip actually worth? If the euro moves up by 1 pip against the dollar, how much money is that? Is it a penny? $1? $1,000? The answer, and this is critically important, is it depends. This isn't like a stock going up by $1, where you know that if you own 10 shares, you just made $10. The value of a pip is not fixed. It's determined by two things: the currency pair you're trading, and more importantly, the size of your trade. Let's imagine a trader, we'll call him Mike. Mike is sharp, he's been acing his stock trades on Robinhood, and now he's looking at Forex. He sees the euro to US dollar pair move up 10 pips. He does another trade and sees it move up 20 pips. He thinks, okay, I get it. A bigger pip move means more money. And he's right, but he's missing the most important part of the equation. One day, Mike places a small trade, just dipping his toes in the water. He risks a small amount of his capital. The market moves in his favor by 50 pips, a pretty decent move. He looks at his account and sees he made $5. He thinks, okay, so 50 pips is $5. Got it. The next day, he's feeling more confident. He sees what he thinks is the exact same setup. The same pattern, the same feeling in his gut. This time, he decides to put more capital on the line. He increases his trade size significantly. The market moves in his favor again by the exact same 50 pips. He's expecting a proportionally larger gain, maybe $50, maybe $100. He closes the trade, the rush of excitement hits him, and he looks at his screen. His profit isn't $50. It's $500. His jaw hits the floor. For a moment, he feels like a genius, like he's cracked the code. But then, a cold wave of realization washes over him. If a 50 pip move in his favor made him $500, what would a 50 pip move against him have done? He would have lost $500. On a trade where he was mentally prepared to maybe lose 50. He just exposed himself to 10 times more risk than he was aware of, all because he didn't understand that the value of a pip is directly tied to the size of his position. This is the core concept. The same 50 pip move can be worth $5 or $50 or $500 or even $5,000. It all comes down to your trade size, which in the Forex world is measured in something called lots. We'll dive deep into lot sizes in a later part, but for now, just burn this into your mind. Pip movement tells you how far the market moved, but your trade size determines how much that movement impacts your wallet. So why is this so important on a platform like Robinhood, which is designed to be simple? Robinhood might just show you your profit and loss in dollars and cents, hiding the complex calculations in the background. It might feel like you don't need to know about pips. This is a dangerous illusion. Understanding pips is like having X-ray vision into the market's volatility and your own risk. When you see a stock bounce around by 50 cents, you have a feel for that. But what does a 30 pip move in the Australian dollar versus the Canadian dollar feel like? Is that a huge, chaotic swing? Or is that just normal daily noise? Without understanding pips, you have no context. You're flying blind. You can't compare volatility between different pairs. A 100 pip daily range in one pair might be completely normal, while in another, it could be a sign of a massive, news-driven event you should be wary of. Knowing about pips helps you set realistic targets and, more importantly, realistic stop losses. A stop loss is an automated order to close your trade if it moves against you by a certain amount, protecting you from catastrophic losses. New traders often set their stop losses based on a random dollar amount, like, I'll get out if I lose $20. This is a recipe for disaster. Why? Because on a large trade, a tiny meaningless 5 pip wiggle in the market could trigger that $20 loss and kick you out of a potentially winning trade. On a very small trade, that same $20 loss might require a massive 200 pip move against you, exposing you to way more risk than necessary. Professional traders don't think in dollars, they think in pips. They say, my stop loss is 20 pips below my entry. Or, I'll take profit if the price moves 60 pips in my favor. They do this because pips are the universal language of the Forex market. It's a standardized measure of movement that is independent of their account size. They calculate their risk in pips first, and then they adjust their trade size, their lot size, to make sure that a 20 pip loss equals a specific predetermined dollar amount they are comfortable losing, say 1% of their account balance. This is the foundation of risk management. It's the difference between gambling and trading. It's the mental shift from being a passenger in the market to being the pilot of your own account. You start making decisions based on the market's own rhythm, its own volatility, measured in pips, not on arbitrary dollar figures that have no connection to what the currency pair is actually doing. So when you open Robinhood and prepare to trade Forex, remember Mike. Remember that the dollar figure you see, the profit or loss, is just the outcome. The process, the real story of the trade, is being written in pips. Learning to read that story is the first major step toward navigating these markets with intention and a plan. It allows you to understand the risk you're taking before you enter the trade. And in a market that moves trillions of dollars a day, understanding your risk isn't just important, it's everything. But this brings up an even bigger question. If the value of a pip depends on your trade size, how are you able to control thousands or even tens of thousands of dollars worth of currency with just a few $100s in your account? How is it possible for a 50 pip move to generate a $500 return on a small account? This isn't magic. It's a powerful and often misunderstood tool that every Forex platform, including Robinhood, has built into its core. It's a tool that can amplify your potential gains, but it can also amplify your potential losses at a terrifying speed. And it all comes down to something Wall Street pros call leverage. Understanding how leverage works and specifically how Robinhood applies it to your Forex trades might be the single most important financial concept you learn this year. It's a financial amplifier, a tool that lets you control a massive amount of currency with a relatively tiny amount of your own money. Think of it like this: imagine you want to buy a $1 million house. Normally, you'd need a down payment of say $200,000. But what if the bank said, you know what? Give us just $10,000 and we'll let you control the entire $1 million property. If it goes up in value, you keep the profit as if you own the whole thing. That's leverage. In the Forex market, your broker, in this case Robinhood, is the bank. The money you put up is called margin. Let's put some real numbers on this because this is where it gets wild. In the world of Forex, it's common to see leverage ratios like 50 to 1. What does that mean? It means for every $1 of your own money you put up, you can control $50 in the market. So, if you have just $1,000 in your Robinhood account dedicated to Forex trading, a 50 to 1 leverage ratio allows you to command a position worth $50,000. Your brain should be lighting up right now with both excitement and a healthy dose of fear. And it should be, because this is the very definition of a double-edged sword. Let's walk through a case study, a tale of two trades to see how this power can build fortunes and just as easily shatter them. Meet Sarah. Sarah's a new trader, and she has $1,000 she's ready to put to work. She's been watching the euro versus the US dollar, the euro to US dollar pair. She believes, based on her research, that the euro is about to strengthen against the dollar. In a world without leverage, Sarah would take her $1,000 and buy 1,000 euros. Let's say the exchange rate is 1.0800. If the rate moves up by just 0.5% to 1.0854, a decent move for a single day, she could sell her euros back for dollars. Her profit? A little over $5. After a day of watching charts, she's made enough to buy a fancy coffee. It's underwhelming. This is why almost no one trades Forex without leverage. Now let's give Sarah the superpower. Robinhood offers her 50 to 1 leverage on the euro to US dollar pair. She still has her same $1,000. But now, she can use that $1,000 as margin to control a $50,000 position. She makes the exact same trade, believing the euro will rise. The market moves in her favor by that exact same 0.5%. But this time, that 0.5% gain isn't on her tiny $1,000 stake. It's on the full $50,000 position she controls. The profit from that move is now $250. Let that sink in. With the exact same market movement and the exact same starting capital, she didn't make $5. She made $250. That's a 25% return on her initial capital. In a single day, her account, which started at $1,000, now sits at $1,250. This is the siren song of leverage. It's the allure. It's the mechanism that turns the tiny, fractional movements of the Forex market into potentially substantial outcomes. It's what makes this whole thing work. But every superpower has a weakness. Every hero has a vulnerability. And for leverage, the vulnerability is that it amplifies everything. Not just the wins. It amplifies the losses with the exact same brutal efficiency. Let's rewind. Sarah, with her $1,000 and her 50 to 1 leverage, controls a $50,000 position. But this time her research was off. An unexpected news report comes out, and the US dollar strengthens instead of the euro. The market moves against her, and it moves by that same 0.5%. On her leveraged $50,000 position, that 0.5% loss isn't $5. It's $250. In the blink of an eye, a quarter of her trading capital has vanished. Her account is down to $750. The emotional high she felt just imagining the win is now replaced by a pit in her stomach. But what happens if the market moves against her by 1%? The loss is now $500. Half of her entire account gone. What if it moves by 2%? A 2% loss on a $50,000 position is $1,000. Her entire starting capital would be wiped out. This is the dark side of leverage. It's an unforgiving force that takes no prisoners. And this brings us to a terrifying concept that every leveraged trader must understand: the margin call. Or in the modern world of app-based trading, the auto liquidation. Remember, your $1,000 is the good faith deposit, the margin. The broker is lending you the other $49,000. They are not going to let you lose their money. As your trade moves into a loss, you are eating away at your margin. As that $1,000 cushion gets thinner and thinner, the broker's internal alarms start screaming. In the old days, they'd literally call you on the phone, the dreaded margin call, demanding you deposit more money immediately or they would close your position. Today, on a platform like Robinhood, it's far more sterile and infinitely faster. There is no phone call. An algorithm simply liquidates your position for you. It closes your trade automatically at a loss to ensure you can't lose more money than you have in your account. Imagine watching your trade, hoping it will turn around, and then poof, it's gone. Closed by the system. The loss is locked in. You had no say. The machine made the decision to protect itself, and in doing so, it crystallized your failure. This is the single most jarring experience for a new Forex trader. Feels like the game is cheating. But it's not. It's just the cold, hard math of leverage enforcing its rules. Understanding this dynamic is more than just a technical lesson. It's a psychological one. Leverage turns up the emotional volume on everything you do. A small win feels like you've conquered the world, which can lead to overconfidence and taking even bigger risks. A small loss feels catastrophic, which can lead to what's known as revenge trading. Jumping right back into the market with a reckless trade to try and win your money back, which almost never ends well. So how are you, a trader in the US using Robinhood, supposed to handle this immense power? First, you have to reframe what leverage is. It is not a tool to get rich. It is a tool for capital efficiency. It allows you to operate in a massive market without needing millions of dollars in the bank. That's it. You must treat it with the respect you would a loaded weapon. Second, understand that the leverage Robinhood offers is likely to be a feature, not a bug. In the US, Forex leverage for retail traders is regulated and capped, typically at 50-1 for major pairs. This is a stark contrast to some offshore brokers that might tempt you with insane leverage of 500-1 or even 1,000-1. Those are not tools, they are ticking time bombs. The regulatory caps in the US are there to protect you from blowing up your account with a single bad trade. See them as a safety net. Finally, and this is the most critical part, your defense against the dangers of leverage is not to avoid it, but to manage it with ferocious discipline. And you do that through something called position sizing. Just because you can control a $50,000 position with your $1,000 doesn't mean you should. A professional trader thinks not in terms of potential profit, but in terms of acceptable loss. They decide before they enter a trade how much of their total account they are willing to risk. A common rule of thumb is to risk no more than 1-2% of your trading capital on any single trade. Let's go back to Sarah and her $1,000. A 2% risk means the absolute most she is willing to lose on this one idea is $20. Now she can use leverage to calculate a position size where her predetermined exit point, her stop loss, if it gets hit, will only cost her $20. She might still be controlling a position worth thousands of dollars, but the actual amount of her own money at risk is tiny and predefined. She is using leverage to get exposure, but she is using disciplined risk management to survive. This is the secret. Leverage is the engine, but risk management is the brake and the steering wheel. Without the brakes, the engine's power is worthless because you're guaranteed to crash. By controlling your risk on every single trade, you control the leverage. You tell it what to do. You don't let it tell you what to do. So now we've dissected the engine of the Forex market. We understand the power, the danger, and the discipline required to handle it. But this brings up the next logical question. We have this powerful engine, but where do we drive it? The Forex market isn't one single thing. It's a vast landscape of different currency pairs. You have the majors, the minors, the exotics. Each one behaves differently with its own personality, its own risks, and its own potential. Choosing the right pair to trade, especially as a beginner, is just as important as understanding leverage. And picking the wrong one can be like taking a race car off-roading. A recipe for disaster. So let's avoid that disaster. Let's talk about choosing your vehicle. In the world of Forex, this means picking your currency pair. Think of the global currency market as a massive city. There are sprawling superhighways, busy main streets, quiet suburban roads, and even some treacherous unpaved back alleys. As a new driver, you don't start on the back alleys. You start on the main roads where the traffic is predictable and the rules are clear. In Forex, these main roads are called the major pairs. These are the 7 most traded currency pairs in the world, and they all have one thing in common: the US dollar. They are the giants, the titans of the market, accounting for over 2/3 of all daily Forex transactions. This incredible volume means they have high liquidity, and high liquidity is your best friend as a new trader. It means you can almost always get in and out of a trade at a fair price, with very low transaction costs, known as the spread. On an app like Robinhood, these are the pairs you'll see featured most prominently, and for good reason. They are the bedrock of the market. Let's meet the main characters. First, you have the king of them all, the euro to US dollar. Euro versus the US dollar. This isn't just a currency pair. It's an economic heavyweight title fight between the 2 largest economies on the planet. It's the most traded, most liquid, and most analyzed pair in existence. Because of this, its movements are often smoother, more technical. It's the superhighway. The traffic flows, the lanes are wide, and while accidents can happen, the path is generally well defined. News from the US Federal Reserve or the European Central Bank can cause massive waves, but for the most part, it's the gentle giant of the Forex world. Then there's the US dollar to Japanese yen. The US dollar versus the Japanese yen. This pair has a completely different personality. It's often called the gopher. It's incredibly sensitive to global risk sentiment. Think of the Japanese yen as a financial storm shelter. When investors around the world get scared, a stock market crash, a political crisis, a pandemic, they often pull their money out of riskier assets and pile it into the perceived safety of the yen. This causes the US dollar to Japanese yen to fall, sometimes dramatically. Conversely, when everyone is optimistic and buying stocks, the yen is often sold off and the pair rises. Trading this pair isn't just about economics. It's about reading the collective fear and greed of the entire global market. Next up, the pound sterling to US dollar. The British pound versus the US dollar. Its nickname is the cable, a name that dates back to the 1800s when the exchange rate was transmitted between London and New York via a giant transatlantic telegraph cable. And that history hints at its personality. It's old school, powerful, and wildly unpredictable. The cable is known for its volatility. It can swing hundreds of points in a single day. It's a bucking bronco. The Brexit saga was a masterclass in the cable's wild nature, with moves that wiped out accounts and created fortunes overnight. It demands respect and a deep understanding of the UK's economic pulse. For a beginner, it's like learning to drive in a souped-up muscle car. Exciting, but you better know where the brakes are. These are just 3 of the majors. You also have the commodity currencies, the Australian dollar, the New Zealand dollar, and the Canadian dollar, each paired against the US dollar. Their value is heavily tied to the price of commodities like oil, gold, and agricultural products. The US dollar to Canadian dollar, or the loonie, for example, often moves in tandem with the price of crude oil, since oil is Canada's largest export. Trading these pairs means you're not just a currency trader, you're also a part-time commodities analyst. Beyond the majors, you have the minor pairs, or crosses. These are pairs that don't involve the US dollar, like the euro to pound sterling or the Australian dollar to Japanese yen. These are the busy main streets connecting different parts of the city. They can offer unique opportunities, but they often have slightly higher transaction costs and can be more complex, as you're now analyzing the relationship between 2 non-US economies, while still being indirectly influenced by what the dollar is doing. And finally, you have the exotics. These are the unpaved back alleys. An exotic pair consists of a major currency against the currency of an emerging or smaller economy, like the US dollar versus the Mexican peso or the South African rand. These pairs can be incredibly volatile. Their spreads are wide, liquidity is thin, and they are highly susceptible to local political and economic shocks. A single news event in that country can cause the currency's value to swing by massive percentages in minutes. For a new trader, venturing into the exotics is like taking that race car off-roading in the middle of a jungle at night. It's a path best left to the seasoned experts. So, you're on Robinhood looking at this list of pairs. Euro to US dollar to Japanese yen, pound sterling to US dollar. Where do you even start? It feels like being at a buffet and everything looks interesting. The The temptation is to try a little bit of everything. You see a news alert about Japan, so you jump into US dollar to Japanese yen. Then you hear a commentator talk about oil prices, so you open a trade on US dollar to Canadian dollar. Then you see a big spike on the euro to US dollar chart and you feel like you're missing out. This is a classic beginner's mistake. It's called chasing the market. And it's the fastest way to get overwhelmed, confused, and lose your capital. You're trying to drive 5 different cars on 5 different roads at the same time. Here is perhaps one of the most valuable pieces of guidance for anyone starting out. Pick one. Just one. I want you to think about it like learning a language. You wouldn't try to learn Spanish, Japanese, and Russian all at the same time by studying them for 10 minutes each every day. You'd get them all jumbled up and become fluent in none of them. The effective approach is to immerse yourself in one language first. You learn its grammar, its vocabulary, its rhythm, and its culture. The same principle applies to currency pairs. Choose one major pair and make it your singular focus. For the next month, your goal isn't to make a ton of money. Your goal is to become an expert on that one pair. Let's say you choose the euro to US dollar. You will watch it every day. You'll learn its personality. You'll start to notice how it behaves when the London market opens, and how that changes when New York comes online. You'll pay attention to the economic news releases from both the US and the Eurozone. You'll read about the interest rate policies of the Fed and the ECB. You will get a feel for its typical daily range. You'll start to recognize recurring patterns in its price movement. You are effectively turning a chaotic global market into a manageable, personal laboratory. You're not trying to understand everything at once. You're trying to understand one thing deeply. By focusing on a single pair, you filter out 99% of the market noise. You simplify the variables. You reduce the chances of analysis paralysis. You are building a foundation of true understanding brick by brick. Your first few weeks or months on Robinhood shouldn't be about chasing signals across a dozen different charts. It should be a deep dive, a specialization. Become the person who knows the euro to US dollar, or the US dollar to Japanese yen inside and out. This intense focus does something incredible. It accelerates your learning curve exponentially. The patterns you learn, the discipline you build, and the understanding of market structure you gain from mastering one pair are universal. They are skills you can later apply to any other pair you choose to trade. So your first real decision as a US trader on Robinhood isn't which trade to take. It's which pair to study. Do you want the smooth, high-traffic lanes of the euro to US dollar? The psychological puzzle of the US dollar to Japanese yen? Or the volatile thrill of the pound sterling to US dollar? There's no right or wrong answer. The best pair to start with is the one whose story and personality you find most interesting, because that's the one you'll have the motivation to study relentlessly. By mastering one small corner of this massive market, you're building the foundation for everything that comes next. Because before you can read the entire library of the market, you have to learn how to read a single page. And that page is your chart. And that page is your chart. At first glance, it looks like a chaotic mess. A jagged, unpredictable line that seems to have a mind of its own. It's like being handed a book in a language you've never seen before. You can see the letters, the symbols, but they hold no meaning. But what if I told you that every peak, every valley, every single tick up or down is not random noise? What if I told you it's a story? It's the most epic, high-stakes story ever written. And it's being told in real time 24 hours a day, 5 days a week. It's the story of a global battle between two massive armies. The buyers and the sellers. The bulls and the bears. Every single moment on that chart is a footprint left behind by this colossal struggle for control. And your job as a trader is to learn how to read that story. To decipher the language of price. The simplest way to view this story is through a line chart. This is probably what you see by default on many financial news sites or even on the basic Robinhood interface. A line chart is clean and simple. It connects the closing price of one period to the next, creating a smooth, flowing line. It's great for getting a quick, big-picture overview of the general direction of a currency pair. Is it generally going up? Is it generally going down? The line chart will tell you that in a heartbeat. But its simplicity is also its greatest weakness. It hides all the drama. It shows you who won the war, but it tells you nothing about the battles that were fought along the way. It's like reading the last page of a novel without knowing any of the plot twists. For a trader, the details of those battles are where the opportunities often lie. That's why most traders quickly move on to what's called a bar chart, or an OHLC chart. OHLC stands for open, high, low, and close. Instead of a simple dot for the closing price, you get a vertical bar that tells you the entire story of that time period. The very top of the bar shows the highest price the currency reached. The very bottom shows the lowest price. A small horizontal tick on the left side of the bar shows the price where the period opened, and a small horizontal tick on the right side shows where it closed. Suddenly, you have 4 critical pieces of information for every single period instead of just one. You can see the full trading range, the entire battlefield. You can see if the price closed higher or lower than it opened. The story is starting to get much more interesting. But the gold standard, the language that nearly every Forex trader across the globe chooses to speak, is the Japanese candlestick chart. It conveys the exact same information as a bar chart, the open, high, low, and close, but it does so in a way that is far more visual, more intuitive, and frankly more powerful. Once you learn to read candlesticks, a bar chart will feel like reading black and white text after you've just watched a full-color IMAX movie. Each candlestick has 2 main parts. The thick part is called the real body. This represents the range between the open and the close price. If the body is green or sometimes white, it means the closing price was higher than the opening price. The bulls, the buyers, won that session. If the body is red or sometimes black, it means the closing price was lower than the opening price. The bears, the sellers, were in control. The thin lines sticking out from the top and bottom of the body are called wicks, or shadows. The top of the upper wick shows the absolute highest price reached during that period, and the bottom of the lower wick shows the absolute lowest price. Think of each candlestick as a single round in a heavyweight boxing match. The real body tells you who won the round. A big green body means the buyers landed a decisive blow. A big red body means the sellers dominated. The wicks tell you the rest of the story. Imagine a candle with a small red body but a very long lower wick. What does that tell you? It tells you that during that round the sellers came out swinging. They pushed the price way down deep into enemy territory. But then before the bell rang, the buyers mounted a furious comeback. They fought back, pushing the price all the way back up near where it started. So even though the sellers technically won the round because the price closed slightly lower, the real story is the massive buying pressure that emerged at the lows. That long lower wick is a footprint, a clue that the buyers are digging in their heels and might be ready to take control. This is the language of price action. It's not just about red or green. It's about the shape, the size, and the context of each candle that tells the true story of the battle. Now, a critical question arises. A round of what? How long is each round in this fight? This is where the concept of timeframes comes in, and it is absolutely fundamental. When you look at a chart on Robinhood or any platform, you can choose your time frame. You might see options like 1M, 5M, 15M, 1H, 4H, 1D. That's 1 minute, 5 minutes, 15 minutes, 1 hour, 4 hours, and 1 day. Each candlestick on your chart will represent exactly that amount of time. If you're on the 1 hour chart, each candle tells the story of 1 hour of trading. If you switch to the daily chart, each candle now represents the entire 24-hour trading day. This is like having a zoom lens on the market. The daily chart is the satellite view. It shows you the grand sweeping mountain ranges and valleys, the major long-term trends that have been forming for months or even years. It filters out all the minor daily noise. A long-term swing trader might base their entire strategy on this view. Then you can zoom in. The 4-hour or 1 hour chart is like the view from an airplane. You can start to see the major highways, the rivers, the shape of the city. You see the medium-term trends, the significant moves that happen over the course of a week. This is where many day traders and short-term swing traders spend their time. Then you can zoom in even further. The 15-minute and 5-minute charts are the street-level view. You can see every car, every turn, every traffic light. This is where you see the short-term volatility, the noise we filtered out on the daily chart. This is the world of the scalper and the very short-term day trader, who are looking to capitalize on small moves happening right now. There is no best time frame. A new trader often asks, "What time frame should I use?" That's like asking a photographer, "What lens should I use?" The answer is, it depends on what you're trying to capture. Are you trying to capture the majestic landscape or the intricate details of a flower? Your trading personality and strategy will determine your time frame. If you have a full-time job and can only check the charts once a day, the daily chart might be your home. If you plan to be an active day trader, the 1 hour and 15-minute charts might become your best friends. The key is to understand that what looks like an unstoppable straight-up trend on a 5-minute chart might just be a tiny, insignificant blip upwards on a daily chart that is in a massive downtrend. Context is everything, and time frames provide that context. This is called multiple time frame analysis, a concept we'll dive into later, but for now, just know that learning to look at the market from different zoom levels is a professional habit. When you open the euro to US dollar pair on Robinhood, you'll see a chart. By default, it might be a line chart, but with a quick tap, you can switch it to the candlestick view, which is where the real story unfolds. You can also easily toggle between the different time frames, from the hourly to the daily, to change your perspective. I encourage you to do this. Don't even think about placing a trade. Just observe. Switch to a 1-hour chart, and watch how a single candlestick forms over the course of an hour. Watch the battle happen in real time. See how the wicks are formed as price pushes up and down, and how the body changes color as the open and close prices shift. You are now beginning to read the language of the market. You're moving beyond seeing just a squiggly line and starting to see the narrative of supply and demand, fear and greed, playing out right in front of you. Every candlestick pattern, every chart formation, every trading strategy you will ever learn is built upon this fundamental understanding of what a single candle on a specific time frame represents. It is the atomic unit of market analysis. By learning to read the story of one candle, you are building the skill to read the story of thousands of them put together. Now that you can read the individual words on the page, the candlesticks, it's time to learn how to read the sentences and paragraphs. It's time to understand the two fundamental forces that move every single market: support and resistance. These are the invisible floors and ceilings of the financial world, and learning to see them is the next critical step in your journey. Imagine you're in a big empty room with a super bouncy ball. You throw it down. It hits the floor and bounces up. It hits the ceiling and comes back down. Floor, ceiling, floor, ceiling. The price of a currency pair on a chart behaves in a very similar way. The floor is what traders call support. The ceiling is what they call resistance. These aren't just random lines. They are psychological battlegrounds where the collective will of millions of traders clashes. Let's start with the floor, support. A support level is a price point where a currency pair seems to have trouble falling further. Think of it as a price that looks like a bargain. As the price drops and approaches this level, the buyers, the bulls, start to think, wow, the euro is getting cheap against the dollar here. This is a great price to get in. More and more buyers step into the market, and their combined buying power overwhelms the sellers. They create a demand floor, absorbing all the selling pressure and causing the price to bounce back up, just like that ball hitting the floor. It's a line in the sand drawn by the buyers, a collective agreement that, for now, the price shall not pass. Now let's look at the ceiling, resistance. Resistance is the mirror opposite. It's a price level where a currency pair struggles to climb higher. As the price rises towards this level, the sellers, the bears, start to get active. They might be traders who bought at a lower price and are now thinking, this is a fantastic profit. Time to sell and lock it in. Or they might be traders who believe the currency is now overvalued and are initiating new sell orders. This wave of selling pressure overwhelms the buyers, creating a supply ceiling. The upward momentum stalls and the price is pushed back down like the ball hitting the ceiling. It's the peak of optimism, where profit-taking and skepticism create a powerful barrier. So how do you actually see these invisible floors and ceilings on your Robinhood chart? Simpler than you think. You're essentially becoming a market historian. You look to the left on the chart. You're searching for obvious points in the past where the price turned around. Find a low point where the price bounced up. Now scan horizontally to the right. Did the price come down to that same area again and bounce? And again? If you see a price level where the market has reversed from down to up multiple times, you've likely found a support level. You can draw a horizontal line to connect these low points, these swing lows, to visualize it. The same exact process works for resistance. Look for a high point where the price was rejected and fell. Scan to the right. Did it hit that same ceiling again and fall? If you see a price level that has repeatedly capped the market's rallies, you've found a resistance level. Connect those peaks, those swing highs, with a horizontal line. The more times a level has been tested and has held, meaning the price bounced off it, the more significant that level is considered by the market. A floor that has held back the price 5 times is a lot stronger than one that's only been tested once. Now, a critical point that separates beginners from experienced traders. These are not laser-thin, exact to the pip lines. Think of them as zones or areas. The price might dip slightly below a support line, or poke a little above a resistance line before reversing. Don't get faked out by tiny penetrations. Think of it like drawing with a crayon, not a scalpel. You're marking a general price area, a hot zone of activity, not a precise mathematical point. So what happens when the ball finally breaks through the ceiling or smashes through the floor? This is where some of the most significant trading opportunities can emerge. When the price breaks decisively above a resistance level, it's called a breakout. This signifies a major shift in market sentiment. The sellers who were defending that ceiling have run out of ammunition. They've been overwhelmed. Buyers are now in full control. This can trigger a cascade effect. Traders who were waiting on the sidelines might jump in, adding to the buying pressure. Sellers who bet against the currency might be forced to buy back their positions to limit their losses, which ironically adds even more fuel to the fire, often leading to a strong, sustained move upward. Conversely, when the price breaks below a support level, it's called a breakdown. The floor has given way. The buyers who were defending that level have either given up or been completely absorbed. This is often a sign of significant weakness and can trigger a wave of panic selling. People who bought at the support level thinking it was a bargain are now in a losing position and rush to sell to cut their losses. This flood of new sell orders can cause the price to drop sharply and quickly. Here is perhaps the most elegant and powerful concept related to these levels. When a level is broken, it often reverses its role. Think about our room analogy. If you throw the bouncy ball so hard that it smashes through the ceiling, where is it now? It's in the room above. And what is the floor of that new room? It's the very ceiling you just broke through. In trading, this is a core principle. Old resistance can become new support. Once the price breaks out above a resistance level, it will often come back down to test that same level from above. If it bounces off it, it confirms that the former ceiling is now acting as a new floor, providing a potential foundation for the next leg up. The same is true in reverse. When a support level is broken and the price falls through, that old floor can become a new ceiling. The price might try to rally back up, but it will often hit that same level from below and be rejected, confirming that the former support is now acting as a new resistance, capping any potential recovery. Watching for this role reversal is a key skill. It helps you understand the new market structure after a significant break has occurred. Let's make this practical. Open up the Euro to US dollar chart on Robinhood and switch to the daily view, where each candle represents one day of trading. Look back over the last 6 months to a year. Can you spot areas where the price repeatedly turned? Maybe you see a zone around 1.0700 where the price bounced up 3 separate times. You draw a support line there. Maybe you see another area up near 1.1000 where the price hit a wall and fell back twice. That's a potential resistance zone. You are now, for the first time, not just looking at a random squiggly line. You are seeing the hidden architecture of the market. You are seeing the memory of the market, where past battles were fought and won. Finally, remember that context is everything. The significance of a support or resistance level is directly related to the time frame you're looking at. A support level on a weekly chart, which has held for over a year, is a monumental force. It's like the foundation of a skyscraper. A resistance level on a 5-minute chart that formed 20 minutes ago? That's more like a piece of drywall. Can be broken much more easily. Higher time frames create more significant levels because they represent the consensus of more traders over a longer period. By learning to identify these zones, you've taken a giant leap. You've moved from being a passenger watching the price move randomly to being a navigator, reading the map of the market. You can see the potential barriers, the potential floors, and the critical points where a major shift in momentum could be about to happen. You have a framework for analyzing price action. But this is just the map. We've mapped the battlefield. Next, we need to learn how to read the soldiers' intentions. Within these zones, the price forms specific shapes and patterns that tell a story. They are the market's secret language. And in the next part, we're going to learn how to decode the most important dialect of that language: candlestick patterns. Imagine you're looking at a football game, but instead of seeing the players, you only see the line of scrimmage moving back and forth. A big push forward, a slight retreat, a stalemate. Each of those movements tells you who has the momentum, the bulls or the bears. That's exactly what a candlestick chart does. Each candle is a snapshot of one round in an epic, ongoing battle for control of the price. Let's break down the anatomy of a single candle. It might look simple, but it's packed with information. First, you have the main thick part called the body. This tells you where the price opened and where it closed for that specific time period, whether it's 1 minute or 1 day. If the candle is green, it means the price closed higher than it opened. The bulls won that round. The bottom of the green body is the opening price, and the top is the closing price. If the candle is red, the price closed lower than it opened. The bears won. The top of the red body is the open and the bottom is the close. Then you have the thin line sticking out from the top and bottom of the body. These are called wicks or shadows. The wicks tell you the full story of the battle. They show the highest and lowest points the price reached during that round before settling at its close. The very top of the upper wick is the highest price, the absolute peak of the bull's advance. The very bottom of the lower wick is the lowest price, the furthest the bears were able to push. So a long upper wick on a red candle tells a dramatic story. It says the bulls made a powerful charge, pushing the price way up, but the bears not only stopped them but drove them all the way back down and then some, closing lower than where they started. It was a failed bull raid. A long lower wick on a green candle tells the opposite story. The bears tried to drag the price into the abyss, but the bulls staged a heroic defense, repelling the attack and marching forward to close higher. It's a story of resilience. Understanding this core concept, this battle between buyers and sellers captured in the body and wicks, is the key that unlocks everything else. Now let's look at some of the most critical individual characters in this story. The first is the doji. A doji is a candle with a very small body, looking almost like a plus sign or a cross. This happens when the open and close price are nearly identical. It's the ultimate sign of indecision. The bulls and the bears fought to an absolute standstill. Neither side could gain an inch of territory by the end of the round. When you see a doji after a strong trend, it's like the market is taking a deep breath, pausing. It's a warning sign that the current momentum might be fading, and a reversal could be on the horizon. It's not a signal to act, but a signal to pay very close attention. Next, let's talk about the hammer. Imagine a currency pair has been in a downtrend, with red candles pushing the price lower and lower. Then a candle forms that looks like a hammer. It has a small body at the top and a very long lower wick, at least twice the size of the body. This candle tells a powerful story. It says the bears continued their attack, pushing the price significantly lower. But then from out of nowhere, the bulls mounted a massive counteroffensive, driving the price all the way back up to close near where it opened. The bears' assault was completely rejected. Seeing a hammer at the bottom of a downtrend, especially near a support level, is a classic signal of a potential bullish reversal. Its bearish cousin, found at the top of an uptrend, is the shooting star. It's the exact opposite. It has a small body at the bottom and a long upper wick. The story here is that the bulls, full of confidence from the uptrend, made a huge push higher, but they hit a wall of sellers. The bears ambushed them and slammed the price all the way back down to close near the open. It's a story of a failed bull assault, and a sign that the bears are starting to take control. These single candle patterns are like finding a critical clue. But sometimes the market tells its story over 2 rounds or 2 candles. This is where we get to one of the most significant reversal signals, the engulfing pattern. A bullish engulfing pattern happens at the end of a downtrend. You have a red candle, showing the bears are still in control. But the very next candle is a large green candle that completely engulfs the entire body of the previous red candle. It opens lower than the previous close and closes higher than the previous open. This is not just a counterattack. It's a rout. The bulls didn't just stop the bears. They completely overwhelmed them and erased their previous victory in a single powerful move. It's a clear and aggressive statement that the balance of power has likely shifted. The bearish engulfing pattern is its mirror image at the top of an uptrend. A solid green candle is followed by a massive red candle that swallows the green one whole. It signals that the sellers have stepped in with overwhelming force, and the party for the bulls might be over. Now, it is absolutely critical to understand this one point. A candlestick pattern by itself is meaningless. Seeing a hammer in the middle of a choppy, sideways market doesn't tell you much. It's just noise. The power of these patterns is unleashed only when they appear at a significant location on your chart. And what are those significant locations? They are the support and resistance zones we talked about in the last part. Think of it this way. Support and resistance levels are the key battlefields. Candlestick patterns are the signals that tell you who is winning the battle on that specific field. When you see a bullish engulfing pattern forming right on a major support level that has held up in the past, you are witnessing 2 powerful pieces of evidence aligning. The location says buyers have shown up here before, and the candlestick pattern says buyers are showing up right now with overwhelming force. That combination is infinitely more meaningful than either one on its own. A shooting star is interesting, but a shooting star forming right as the price hits a strong resistance level that has rejected the price multiple times before? That's a high probability setup that demands your full attention. The context is everything. The pattern is the what, the location is the where. You need both to understand the why. By learning to read these individual candles and two-candle patterns, you're no longer just looking at random green and red bars on a screen. You're reading the moment-to-moment psychology of the market. You're seeing the fear, the greed, the indecision, and the conviction. You're starting to understand the story as it unfolds, bar by bar. But these single and double candle patterns are like letters and words. They are the building blocks of the market's language. To truly become fluent, you need to learn how to read entire sentences and paragraphs. You need to see how these small patterns combine to form much larger, more powerful structures that can forecast major market moves over days or even weeks. These larger structures are known as chart patterns, and they represent the grand strategy of the market's war. If those individual candlesticks are the soldiers in the trenches fighting inch by inch, then these larger patterns are the battle formations, the troop movements that signal a major offensive or a strategic retreat. Think of yourself not as a soldier, but as a general looking down at the entire battlefield from a hilltop. You're not focused on one single skirmish. You're looking for the formations that reveal the enemy's grand plan. These chart patterns are, quite simply, the geometry of market psychology. They are visual representations of fear, greed, indecision, and confidence, playing out over and over again across every currency pair on the planet. Broadly, these grand strategies fall into two main camps: reversal patterns and continuation patterns. It's as simple as it sounds. Reversal patterns suggest that the current trend is running out of steam and is likely to change direction. A powerful uptrend might be about to fall, or a brutal downtrend might be about to stage a comeback. Continuation patterns, on the other hand, suggest the market is just taking a breather, catching its breath before continuing its original push. Recognizing the difference is like knowing whether an army is retreating or just regrouping for another assault. Let's start with the king of reversal patterns, the one that every trader from Wall Street to Main Street learns to spot: the head and shoulders. Imagine a strong uptrend. The price of the euro is climbing against the dollar, making higher highs and higher lows. This is our army advancing. Then it makes a peak, that's the left shoulder. It pulls back a bit, then rallies with even more force to a new higher peak. That's the head. This is the moment of maximum confidence, the peak of the offensive. But then something changes. The price falls back again, down to the same level as the previous pullback. The buyers try one more time to push higher, but their energy is spent. They can only rally to a lower peak, roughly the same height as the first one. This is the right shoulder. What you're left with is a picture of a failing trend. 3 pushes, with the middle one being the strongest but the final one showing clear exhaustion. If you draw a line connecting the low points of the pullbacks, you get what's called the neckline. In our war analogy, this neckline is the last line of defense. When the price breaks below that neckline, it's often interpreted as a signal that the bulls have surrendered and the bears are now in command. The grand advance has turned into a full-blown retreat. The opposite is true for an inverse head and shoulders, which looks like the same pattern flipped upside down at the bottom of a downtrend, signaling a potential shift from selling to buying. A simpler but equally powerful reversal pattern is the double top or double bottom. This is the story of a market hitting a brick wall. Imagine the price is rallying, it hits a certain level, let's say 1.10 for the euro/dollar, and gets forcefully rejected. It falls back, consolidates, and the buyers gather their strength for another push. They charge again, full of optimism, right back up to that same 1.10 level, and are rejected again just as hard. This creates 2 distinct peaks at roughly the same price level. The story the chart is telling you is that there is a powerful ceiling of sellers at that price. The buyers tried to break through twice and failed. This exhaustion can often lead to a significant reversal to the downside. The double bottom is its mirror image at the end of a downtrend, a floor that sellers try to break through twice, but can't, suggesting the buyers are finally stepping in to defend that level. Now let's talk about the other camp: continuation patterns. These are the patterns that suggest the war isn't over. It's just a temporary ceasefire. The most famous of these are flags and pennants. Picture a massive, explosive move in one direction, a huge green candle or a series of them pushing the price up sharply. This creates what looks like a flagpole. After such an aggressive move, the market needs to pause and digest the gains. It enters a brief period of consolidation, where the price drifts slightly downwards or sideways in a tight, rectangular or triangular shape. This little consolidation looks like a flag or a pennant hanging off the pole. This isn't a sign of weakness, it's a sign of strength. It's the market coiling up, building energy for the next leg of the move in the same direction. When the price breaks out of that flag pattern, it often continues the original trend with renewed force. A bull flag signals a potential continuation of an uptrend, while a bear flag, its opposite, signals a potential continuation of a downtrend. Finally, we have the triangles, which can be the ultimate story of market indecision. There are three main types. An ascending triangle forms when there's a flat level of resistance at the top, a price ceiling, but the low points of each pullback are getting progressively higher. This tells a story of persistent buyers. They keep getting pushed back from the same ceiling, but each time they regroup at a higher level. The pressure is building from below, squeezing the price against that flat top. It's like pushing a wedge under a door, and eventually, that pressure often resolves with a powerful breakout to the upside. A descending triangle is the exact opposite. There's a flat support level at the bottom, a price floor, and the peaks of each rally are getting progressively lower. Sellers are in control, applying more and more pressure, pushing the price down against that floor. The narrative here is one of increasing bearish pressure that often leads to a breakdown. And then there's the symmetrical triangle, where both the highs are getting lower and the lows are getting higher. The price is being squeezed from both sides into the point of the triangle. This is pure, unadulterated indecision. Neither the buyers nor the sellers can gain the upper hand. The market is coiling like a spring, tighter and tighter, until it runs out of room. When it finally breaks out of the triangle, it can lead to a very powerful and volatile move, as one side has finally triumphed and the other is forced to run for cover. When you open your Robinhood app and look at a chart, you can start to see these stories everywhere. You'll see the failed triple assault of a head and shoulders near a major peak. You'll see the brief, orderly pause of a bull flag in the middle of a strong rally. You're no longer just looking at a squiggly line. You're reading the collective hopes and fears of millions of traders around the world, drawn into a visual narrative. But here is the most critical piece of wisdom I can share about these patterns. They are not infallible. They are about probabilities, not certainties. In our war analogy, these formations can sometimes be a feint, a trick by the market to lure you in before reversing course. A pattern might form perfectly, signal a breakout, and then immediately collapse back into the range. This is called a false breakout, and it's the market's way of keeping every general on their toes. These patterns are a guide, a map of potential futures based on historical behavior, but they are not a crystal ball. They represent the psychology of the crowd, and the crowd can be notoriously fickle. The key is to use them as part of a larger strategic plan, not as a standalone command to charge. So we have our soldiers, the candlesticks, and we have our battle formations, the chart patterns. We can now read the moment-to-moment combat and understand the larger strategic plan. But there's a missing piece of the puzzle. How do we measure the morale of the troops? How do we know if the army has the momentum and supply lines to actually win the battle its formation suggests? What if I told you there's a way to get a confirmation that the battle is truly turning in your favor? These confirmations are called indicators, and they are the intelligence reports of our market warfare, giving us a look behind the enemy lines. These tools are not magic crystal balls. They're more like satellites, radar, and thermal imaging combined. They don't tell you what will happen. They give you a calculated, data-driven assessment of what is likely to happen based on past behavior. And in the world of Forex, probability is your greatest ally. Now, before we arm ourselves, you need to understand there are two primary categories of these intelligence reports. First, you have your trend-following indicators. These are your long-range scouts. They are excellent at telling you the overall direction of the market's army. Is it advancing, retreating, or bogged down in a stalemate? They are masters of the big picture. Second, you have your momentum indicators or oscillators. These are your close-quarters combat specialists. They measure the speed and the force of price movements. They tell you if an army's charge is losing steam and getting exhausted, or if a retreating force is digging in its heels, ready for a powerful counterattack. The mistake most new traders make is either using none of these tools or worse, using far too many. They plaster their charts with a dozen different indicators until it looks like a Jackson Pollock painting, a mess of conflicting signals. This leads to analysis paralysis, where you're so overwhelmed with data you can't make a decision. The goal isn't to use every tool in the armory. The goal is to master a select few that work for your strategy. And the good news? The most powerful time-tested indicators are available to you for free right inside your Robinhood app. Let's start with the most fundamental tool of all, the moving average. Think of a moving average as the smoothed-out path of an army's advance. Instead of getting distracted by every little skirmish and zigzag, it shows you the general, undeniable direction of the trend. The most common one is the simple moving average, or SMA. If you use a 50-day SMA, it simply takes the closing prices of the last 50 days, adds them up and divides by 50. Tomorrow it does the same, dropping the oldest day and adding the newest. The result is a single smooth line on your chart that cuts through the noise. Another popular variant is the exponential moving average, or EMA. The EMA is like a more modern responsive scout. It does the same basic job as the SMA, but it gives more weight to the most recent price action. It reacts faster to new information. Many short-term traders prefer the EMA for this reason, as it can signal trend changes a little bit sooner. So how do traders use them? The most basic interpretation is that when the price is trading above a key moving average like the 50 or the 200-day, the general sentiment is considered bullish. When it's trading below, sentiment is considered bearish. But the real power comes when you combine them. This brings us to one of the most famous signals in all of trading: the golden cross and its evil twin, the death cross. A golden cross occurs when a shorter-term moving average, like the 50-day, crosses up and over a longer-term moving average, like the 200-day. This is a classic signal that market observers interpret as a potential shift from a downtrend to a new, powerful uptrend. It's like your forward scouts reporting that the army's momentum has fundamentally shifted to an advance. Conversely, a death cross is when that 50-day moving average crosses down below the 200-day. This is often seen as a confirmation that a new bear market or a significant downtrend could be underway. These are not just lines on a screen, they are visual representations of major shifts in market psychology, and they are patterns that big institutions and algorithms are programmed to watch. But moving averages are trend followers. They are, by their nature, lagging. They confirm a move that is already underway. What if you want to get a sense of the battle's intensity? What if you want to know if the troops are getting tired? For that, we turn to our momentum specialist, the Relative Strength Index, or RSI. The RSI is your Army's morale meter. It's an oscillator that moves between 0 and 100. It doesn't care about the absolute price. It cares about the speed and magnitude of recent price changes. Think of it this way: is the Army charging forward with incredible force, or is it slogging through the mud, exhausted? Traditionally, the RSI is considered overbought when it goes above 70. This doesn't automatically mean sell. It's more like a warning light on your dashboard. It suggests that the buying pressure has been so intense, for so long, that the advance might be overextended and vulnerable to a pullback. The troops are getting tired. When the RSI drops below 30, it's considered oversold. Again, this isn't an automatic buy signal. It indicates that the selling has been so aggressive that the retreat might be losing steam. It's a sign that the sellers could be running out of ammunition, potentially setting the stage for a reversal. But the most powerful way to use the RSI is to look for something called divergence. This is a more advanced technique, but it's a game changer. Imagine the price of a currency pair like the euro to US dollar makes a new high. The Army has pushed further than ever before. But when you look at your RSI morale meter, you see it failed to make a new high. This is called bearish divergence. The price is going up, but the momentum, the force behind the move, is weakening. It's a massive red flag that the trend might be running on fumes. The opposite is true for bullish divergence. The price makes a new low, a new sign of weakness. But the RSI makes a higher low. The selling pressure is actually easing up even as the price falls. It's a subtle clue that the bears are losing their grip, and the bulls might be preparing for a counteroffensive. Finding divergence is like being a detective, spotting clues that most people miss. Okay, we have our scouts, moving averages, and our morale meter, RSI. Now we need our command center. We need a tool that combines trend and momentum into one comprehensive view. That tool is the MACD, which stands for Moving Average Convergence Divergence. Sounds complicated, but the analogy makes it simple. The MACD consists of three parts. First, you have the MACD line itself. Think of this as your fast-moving Special Forces unit. It's calculated by subtracting a long-term EMA from a short-term EMA, so it's very responsive to price changes. Second, you have the signal line. This is your main infantry, a moving average of the MACD line itself. It's slower and more deliberate. The core signal that traders watch for is the crossover. When the Special Forces, the MACD line, cross above the main infantry, the signal line, it's considered a bullish signal, suggesting momentum is shifting to the upside. When the MACD line crosses below the signal line, it's a bearish signal. The third part of the MACD is the histogram. This is simply a visual representation of the distance between your special forces and your main infantry. When the bars on the histogram are tall, it means your two units are far apart and the trend has strong momentum. When the bars get smaller and shrink towards the zero line, it means your units are getting closer together, and momentum is fading. A trader might use this by waiting for a bullish crossover, the MACD line crossing above the signal line, and then watching the histogram grow, confirming that the bullish momentum is increasing. They might then look to exit the trade as the histogram starts to shrink back towards zero, signaling that the move is losing steam. These three tools, moving averages, RSI, and MACD, form a powerful trifecta of technical analysis. One tells you the trend, one tells you the momentum, and one combines them both. By learning to read these intelligence reports, you stop guessing and start strategizing. You move from being a pawn on the board to being the player looking down at it, anticipating the next move. But having this intelligence is only half the battle. You can have the perfect entry signal, a golden cross confirmed by bullish MACD momentum, and still lose everything. Why? Because you haven't defined your mission parameters. You haven't set your rules of engagement. You know when to get in, but you have no idea when to get out, either to take your winnings or to cut your losses. Even the most sophisticated intelligence can't predict a sudden ambush or a surprise attack. So how do you protect your capital when the market moves against you? How do you ensure a winning battle doesn't turn into a loss war? That requires the single most important skill in all of trading, and it's the final piece of our puzzle. That skill is risk management. And I know it sounds about as exciting as reading an insurance policy, but let me reframe it for you. This isn't about being timid. It's not about being scared. Risk management is the art of survival. It's the strategic discipline that separates the flash-in-the-pan gambler from the long-term, consistently profitable trader. It is the armor you wear into battle, the system that keeps you in the game long enough to let your strategy actually work. Without it, even the world's best trading strategy will eventually lead to a $0 account. So what does this armor look like? It's built on two foundational pillars: knowing how much to risk per trade, and mechanically enforcing that limit. First, let's talk about the amount. There's a widely respected guideline in the trading community often called the 1% rule. It's incredibly simple in principle. You should never risk more than 1% of your total account balance on any single trade. If you have a $1,000 account, your maximum acceptable loss on one trade is $10. If you have a $5,000 account, it's $50. That's it. Now, your first reaction might be, $10? $50? How am I ever supposed to make real money with that? And that's the gambler's mindset talking. The professional understands the power of this rule. Think of a professional boxer. They don't walk into the ring and just start throwing haymakers, hoping for a first-round knockout. They'd be exhausted and vulnerable in minutes. Instead, they use jabs, they manage distance, they conserve energy. They know the fight is 12 rounds long. The 1% rule is your jab. Keeps you in the fight. It allows you to withstand a string of losses, and trust me, you will have strings of losses. It's a statistical certainty. If you risk 10% of your account per trade, you only need 10 losing trades in a row to be completely wiped out. 10. That can happen in a single bad week. But if you risk only 1%, you would need 100 consecutive losses to blow up your account. The odds of that happening with even a halfway decent strategy are astronomically low. The 1% rule gives you staying power. It transforms a catastrophic loss into just a piece of data, a small cost of doing business, allowing you to move on to the next trade with a clear head and most of your capital intact. But having a rule is useless if you don't enforce it. And that brings us to the second pillar, the stop-loss order. A stop-loss is your non-negotiable exit plan. It's a preset order you place with your broker to automatically close your trade if the price moves against you to a specific, predetermined level. It is your mechanical ejection seat. Before you even click the buy or sell button, you must know exactly where your trade is invalidated. Where does the price have to go for your initial idea to be proven wrong? That is where your stop-loss goes. Placing a stop-loss does something almost magical. It removes the single biggest point of failure in trading: your own emotions in the heat of the moment. When a trade is going against you, your brain will start playing tricks. It will whisper, "Just a little more room, it's about to turn around." It will flood you with hope, a dangerous and expensive emotion in the markets. You'll watch your small loss turn into a medium loss, then a large one, all while you're frozen, hoping for a reversal that may never come. A stop-loss takes that decision out of your hands. The decision was already made when you were calm, rational, and analytical before you entered the trade. The machine simply executes your plan. It is the ultimate tool of discipline. So now we have our armor, we risk a small fixed percentage of our capital, and we use a stop-loss to enforce it. But armor alone doesn't win the war. We need a weapon. That weapon is the risk-to-reward ratio. This concept is what flips the entire probability model in your favor. The risk-to-reward ratio, or RR, simply compares the amount you're risking to the amount you're targeting as profit. Let's go back to our $50 risk on a $5,000 account. If you're risking $50, you shouldn't be aiming to make $50. That's a 1-to-1 risk to reward. With a 1-to-1 ratio, you'd need to be right more than 50% of the time just to break even after accounting for spreads. Successful trading systems are often built on what's called an asymmetric risk-to-reward profile. This means your potential winners are significantly larger than your potential losers. A common target for many traders is a minimum of 1 to 2. For every $1 you risk, you are aiming to make at least $2. Risk $50 to make $100. A 1 to 3 ratio is even better. Risk 50 to make 150. Think about what this does to the math. If you are consistently targeting a 1 to 3 risk-to-reward ratio, you can be wrong on 2 out of every 3 trades and still break even. Let that sink in. You can be a terrible predictor of market direction, winning only 33% of the time, and you still won't lose money. If you can push your win rate to just 40% or 50%, your account begins to grow systematically. This is the math that underpins professional trading. It's not about being a market wizard who's right all the time. It's about being a superb manager of risk and probabilities. It's about ensuring your winning trades pay for your handful of losing trades and then some. You are the casino. The casino doesn't win every hand of blackjack. Doesn't have to. It just needs its small statistical edge to play out over thousands of hands. Your positive risk-to-reward ratio is your edge. Let's tie this all together. You've done your analysis on the euro versus the US dollar. You believe it's going to go up. You identify your entry point. Before you do anything else, you identify where your stop-loss needs to go, perhaps just below a recent swing low. You measure that distance. Let's say it's 25 pips. Now, you look for a logical profit target, maybe a previous resistance level, that is at least 50 pips away, giving you that 1 to 2 ratio. Only now, with your entry, your stop, and your target all defined, do you calculate your position size. Based on your 1% rule, you know you can risk $50. So you adjust your trade size so that if those 25 pips of risk are hit, you lose exactly $50, no more. You place the trade, you set the stop-loss order, you set your take-profit order, and then you walk away. The trade plan is locked in. The outcome is now in the hands of the market, and you have controlled the only thing you ever truly can, your potential loss. This entire process, from the 1% rule to the stop-loss to the risk-to-reward ratio, is the foundation of a trading plan. It's what turns a random punt into a structured business decision. And over the course of this series, we've built that plan from the ground up. We started with the absolute basics of what Forex even is. We layered on the language of the charts with technical analysis, support, resistance, trends, and patterns. We added context and power with fundamental analysis, understanding how interest rates and economic news move currencies. And now, we've encased it all in this non-negotiable suit of armor called risk management. This is not the end of your journey. This is the end of the beginning. What you have now is not a guarantee of success, but a framework for survival and a license to learn. Your next step isn't to go and risk your hard-earned money. Your next step is to open a demo account and practice. Practice applying these principles. Take dozens, even hundreds of simulated trades. Keep a journal. Track your results. See what works and what doesn't. Find your edge. Trading Forex on a platform like Robinhood has made the world's largest market more accessible than ever before. But accessibility does not lower the bar for the discipline required. The journey to becoming a consistently successful trader is a marathon, not a sprint. It demands patience, a commitment to continuous education, and an unwavering respect for risk. But by focusing on a sound process, by protecting your capital above all else, and by playing the long game of probabilities, you give yourself a fighting chance to navigate the incredible, challenging, and potentially rewarding world of the foreign exchange market. The puzzle is complete. Now the real work begins.